So what's up, friends? Tammy here. So this is wild. After President Trump tweeted about creating a 50-year mortgage to lower payments for people like you, my inbox blew up. A lot of you are asking, should you wait to buy until this loan comes out? I know that I might get some pushback for saying this, but to me it is pretty simple. A 50-year mortgage is a disaster waiting to happen. This is totally uncharted territory, and if one thing goes wrong, it can hurt you as a buyer and the housing market. All right, let's back up a second and let's talk about where the whole mortgage idea started. The 30-year mortgage didn't come out of nowhere. It was created after World War II to help families buy homes and to help the country grow. By the 1950s, it became standard because it gave people time, 30 full years, to pay off a house without the payments being too high. And honestly, it worked. Today, most buyers, over 90%, pick a 30-year mortgage loan because it's simple, stable, and predictable. Your payments stay the same, you know what to expect, and almost every bank offers it. Sure, there are other loan types out there. You've got a 15-year mortgage, you've got adjustable mortgages, and you've also got interest-only loans. You do have many choices. But the 30-year mortgage is the one that most people pick. And now people are talking about a 50-year mortgage, which is completely new territory. Before we even talk about a 50-year loan, it's important to know how a normal mortgage works. And don't worry, I'm going to explain it in the simplest way possible. When you make a mortgage payment, it's split into two parts. Principal, the part that pays down what you actually owe. Interest, the fee the bank charges you for lending you money. Here's the part that most people don't realize. In the beginning, almost all of that mortgage payment goes towards interest. Why? Because in the beginning, your loan is still huge, so the bank charges interest on the full amount. Only a tiny bit goes towards paying down the house. Then slowly, very slowly, over years, your loan balance shrinks. And as it shrinks, more of your payments start going towards the principal. That's how you finally build real equity. But here's a catch. Most sellers sell their home between 10 and 12 years, long before they ever hit the equity sweet spot. So you've barely started paying down the loan before you move, buy another house, and start all over again. Now let's talk about why most people pick a 30-year mortgage instead of a 15-year mortgage. A 15-year mortgage is great on paper because you pay way less interest over time. But here's the problem. The monthly payment is so much higher that most buyers aren't comfortable or just can't swing it. Let me show you an easy example. We have a $500,000 home. We're going to put 20% down at 6% interest. On a 30-year mortgage, the payments are going to be $2,400 a month. To qualify for this, you would need to make around $7,500 a month, so that's about 3% of your payment. On a 15-year mortgage, that payment jumps to $3,300 a month. And to qualify for that, you're going to need to earn about $10,000 a month. Listen, we know that that is a huge difference for many families. And here's the part that many buyers don't know. Because the payments on a 30-year mortgage are lower, buyers, you can qualify for a bigger home. Choosing a 30-year mortgage lets you increase your purchase power by 34%. That's like going from a $500,000 home to a $670,000 home just because the payments are stretched out further. So of course, most people select the 30-year mortgage. Also, it's easier to qualify for. The payments don't feel as scary, and it opens the door to more homes. And that is how people are thinking themselves into trouble with a 50-year mortgage. Let's break down how a lot of these buyers are getting tripped up. They think, if a 30-year mortgage is cheaper than a 15-year mortgage, then a 50-year mortgage has to be even cheaper. But that's actually where the math completely falls apart. I get it. It sounds 100% logical. I mean, I even want to make that math work, but it doesn't, and it's 100% wrong. Stretching a loan from 30 years to 50 years barely lowers your monthly payment. I mean, like, barely. And on top of that, expect the bank to charge a higher interest rate on that longer loan because it's riskier. I mean, we already see that right now between the 15-year and the 30-year, so don't think it's not going to happen to the 50-year. So you'll be paying way more money for almost no benefit. Remember, I said barely? So the idea of a 50-year mortgage is magically going to make homes more affordable? No, it is just not true. This is where you need to run the numbers because the numbers tell a very different story. All right. Let's break down what a 50-year mortgage does because this is the part that nobody explained. Yes, stretching a loan longer sounds like it should drop your payment a lot. I mean, like a lot, but it doesn't. Going from a 30-year mortgage to a 50-year mortgage only improves your affordability by less than 8%. Yes, less than 8%. That is hardly anything. I mean, think about it. You have to tip higher than that at a restaurant. So instead of paying like 6% on a 30-year mortgage, you could be paying like 7% on a 50. So let's break down the numbers and show what this means for you. Let's say you borrow $500,000 on a 30-year mortgage at 6%. Your payment's going to be around $3,000. Now, if you get a 50-year mortgage, same $500,000 at 7%, your monthly payment is going to be about $3,800. See, it's not cheaper, it's actually more expensive. Now let's enter a fantasy world just for a second. Let's say you're going to borrow that $500,000 at 30 years and at 50 years, and we're going to keep the interest payment the same at 6%. Now remember, on the 30-year, it's a $3,000 a month payment, but on the 50 years, it's going to be around $2,630. That's only a 10% savings in exchange for having a loan hang around for another 20 years. All that time, all that interest for barely any change in your payment. So when people ask me, Tammy, should I wait for a 50-year mortgage? My answer is simple. It doesn't fix the problem for the buyer. It actually makes it worse for you. Now here's the part that really worries me. With a 50-year mortgage, it takes so long to build up any equity in the home that you purchased. Remember earlier when I said that most of your payment at the beginning goes towards the interest? Well, stretch that out over 50 years and it's even worse. Let me show you what that actually looks like. If you buy a house for $550,000, you put 10% down on a 50-year mortgage. And then you actually go to sell your home 12 years later, because remember earlier I said most people stay in their houses between 10 and 12 years. You have paid off about $32,000 in principal over 12 years. That is not a lot. That means if the home values don't go up much, or the market dips even a little, or you suddenly have to move, you can end up underwater, which means that you owe more than the house is worth. And remember, a long time ago, we had this thing called short sales. You could be there. And after paying a mortgage for more than a decade, that's not a place you want to be. I entered the real estate industry during the short sale period, and I can tell you it was awful. And this is what gets me worried when people are thinking that they should get a 50-year mortgage. I don't want this for you. It slows down the equity building in your home so much that you end up stuck with a property for years without much to show for it. And when you're in real life situations, like maybe you're going to get a job and you have to relocate, might possibly move or get a divorce, maybe you're going to have a baby, maybe there are medical situations that come up, you're going to need flexibility. A 50-year mortgage takes that away. Here's something that most people don't realize. Banks don't even want to offer a 50-year mortgage. And once you hear why, it's going to make total sense. Banks make big money in two ways with mortgages. First, they collect interest every month. And two, they bundle loans and sell them to investors so they can lend more money. This system works smoothly with 30-year mortgages because most people move between 7 and 12 years. So the loans get paid off early and the bank gets their money back quickly. But a 50-year loan, that is a nightmare for them. Here's why. If interest rates go down, buyers will refinance into a cheaper loan so the bank will lose money. If interest rates go up, the bank is going to be stuck holding a low interest rate loan for 50 years. And that is a terrible investment for them. When loans are sold on the secondary market, investors want stable returns. A 50-year loan is too slow, too risky, and too unpredictable. So what do banks do when something is risky? They charge more interest to protect themselves. And that is exactly what would happen here. A 50-year loan would almost always come with higher interest, higher total cost, higher risk, and lower equity for you. So even lenders don't benefit from this. And if banks don't like it, that should tell you something. And here's another piece that nobody is talking about. Right now, a qualified mortgage, which is the safest type of loan, cannot be more than 30 years. That's the law. A qualified mortgage gives the bank certain protections if the buyer stops paying. And because the risk is lower, the banks can offer a better interest rate. A 50-year mortgage is not fitting in that box. That means it becomes a non-qualified mortgage, which is a fancy way of saying higher risk, higher interest rates, stricter rules, and fewer lenders willing to offer it. Now let's talk about what would really make home buying easier, because a 50-year mortgage is not the answer. There are simpler things that can be done for buyers that are better than stretching a loan out to half a century. One, we need more homes for sale. Right now, one of our biggest problems is the lack of inventory. We just don't have enough homes on the market. When there are more homes on the market, prices level out and buyers can breathe again. Second, it needs to be easier for sellers to move. A lot of sellers are feeling stuck in their home because they're either not willing to or not able to give up that low interest rate. If people could take their current interest rate with them to the next house, more sellers would list their home, and that would open up more homes for buyers. Number 3, update the tax rules. The capital gains exclusion has not been updated in decades. Raising it would encourage more people to sell, which again will raise inventory. And number 4, better loan programs that actually help. No gimmicks like the 50-year mortgage. Real programs for first-time homebuyers, teachers, nurses, police, firemen, first responders, veterans, and local workers who keep our communities running. These are the things that create real affordability. The 50-year mortgage, it looks helpful on the surface, but it doesn't fix real problems. So here's my real take on the 50-year mortgage. It sounds interesting. It gets people talking. It makes headlines. But when you look at the math, you look at the risk, and you look at the rules, it just doesn't make sense. A 50-year mortgage doesn't make homes more affordable. It doesn't build equity fast enough. And it stretches buyers so thin that one small problem, a job change, a move, a slow market, could really put them in a tough spot. And look, the average home buyer today is around 40 years old. And with a 50-year mortgage, you are paying that house off at 90. Nobody wants that. I want you to buy a house that's going to help your life, not going to trap you. You deserve a loan that's going to build you up, not tear you down. If you're thinking about buying a house, you want to select the loan that's right for you, not the one that sounds good online. I'm here to help you. And if you're planning to move to Florida, I can help you buy here, or I can connect you with a great agent in your city. You don't have to guess your way through this. I've got your back. Click the link in the description below, and let's make sure that you have real information to make the best decision that's right for you. Thanks for watching. I'll see you in the next video.